Investors face a slew of risks, from stubborn inflation to higher interest rates. On today's show, we'll examine ETF strategies for navigating these challenges, along with solutions for diversifying risk and enhancing returns. Paul Baiocchi with SS&C ALPS Advisors joins us right after this. Stick around. Hello and welcome to the program. I'm Stephanie Stanton. It is great to see you again. Be sure to subscribe to ETF Guide TV and post your thoughts in our YouTube comment section below. We are very pleased to have Paul Baiocchi with SS&C ALPS Advisors joining us. Paul, it's great to have you with us. Welcome back.
Thank you. Great to see you again, Stephanie.
So aggressive rate hikes by the Federal Reserve have dramatically altered the bond market. They've also upended the fixed income strategy for those investors who were relying on passive, plain vanilla index funds. As a result, some investors are now turning to professional guidance and looking for a more actively managed approach. And that is where the Smith Core Plus Bond ETF, and that ticker is SMTH, comes in. So tell us more about it.
Yeah, so SMTH is a new launch for us. We launched it in December with our partner, strategic partner, Smith Capital Investors, based here in Denver, headed up by Gibson Smith, former CIO at Janus, a guy with more than 30 years experience in the fixed income market, dating back to his time as an institutional salesperson in that industry. And so he brings this comprehensive experience managing through various ups and downs of various types of fixed income markets, but really it builds on the partnership that we have with SCI. We launched mutual funds with them 6 years ago. We've been very successful in raising assets. The performance of those mutual funds has been very strong, but as you know, some advisors prefer the ETF wrapper, and we've seen tremendous growth and adoption of active ETFs, especially in the fixed income category. And so SMTH really brings a core plus approach to the fixed income ETF world, but ultimately, importantly, does what it's supposed to do as a core plus bond portfolio. What I mean by that is it's a ballast. It is an old school bond strategy in the sense that it's not using obscure fixed income products. It's not using derivatives. It's really sort of taking a typical bond manager's approach to fixed income and doing so leveraging the heritage and experience and track record of the Smith team, which we think is important, especially when you think about the dynamics that you laid out in the question and how challenging the fixed income backdrop is. When you think about the credit space, for example, we've got spreads on investment grade bonds as narrow as they've been in 20 plus years. We've got spreads in high yield credit as narrow as they've been in 15 years. And that's one of the things that SCI does so well is bottom up fundamental credit research. And so we've seen SMTH grow quite rapidly. In fact, it's one of the most successful, earliest gathering ETFs in the active fixed income category historically. But it's also a product that we feel allows people to move away from the ag, to move away from passive. And that's typically been the default setting for a lot of investors in the ETF wrapper. Allocating to fixed income is just buying the index. And we think it's problematic, and leaning on experience and expertise in fixed income, as you can do with SMTH, we think can be really valuable for advisors.
Yeah, and congrats on the success of SMTH so far.
Thank you.
Shifting gears, the real estate market has been facing a glut of office buildings. We're seeing higher financing rates, many other challenges. Over the past couple of years, ETFs linked to the real estate sector have been poor performers. Yet during that same time frame, the ALPS Active REIT ETF, and that ticker is REIT, R-E-I-T, has outperformed passively managed index ETF tracking REITs. What contributed to the success of the ALPS Active REIT ETF versus its peers?
Well, I think you touch on something important here, the disconnect between people's perception of public REITs and what's actually in your typical public REIT portfolio. And what I mean by that is people think REITs, they think real estate, they think, like you said, empty office buildings that you can look through. And the reality is most public REITs that are in your typical passive strategy are in the cell tower space or in the data center space or in the industrial space. And so Public REITs are very different than office REITs in terms of the exposure they provide, the maturity profiles of their debt, and of course, the economic exposures that they provide. And so the team at GSI, which I think a lot, sort of akin to what we talked about with the Smith team, us having these strategic partnerships with firms we believe are best in class, and GSI is the team that runs REIT, has, like SCI, tremendous experience in the real estate space. And their outperformance is driven by sort of old school valuation research that they do on relative sectors in the REIT space, as well as individual firms in the REIT space. So it is a high conviction portfolio of real estate investment trusts pulled from the economic sectors within the real estate market that they think have economic, near-term, intermediate-term, and secular tailwinds. And so when you think about what pockets of REITs are interesting, well, think about data centers. If we're going to do this massive build-out of the infrastructure needed to support AI, well, we're going to need a lot of data centers. And the companies that provide that on a relative basis have very different economic exposures and dynamics than, say, industrial REITs. And so the ability to be flexible, to pick and choose among individual REITs as well as sectors in the REIT category have allowed them to generate really strong relative performance, and why we think this product is such a compelling opportunity for advisors who carve out real estate exposure from their equity exposure or simply just defer to the benchmark once again in REITs.
And flexibility, as you said, is key. Paul, the last time we had you on, we talked about international equity markets and the ALPS International Sector Dividend Dogs ETF, which that ticker is IDOG. I love it. IDOG continues to deliver strong results, and it also recently outperformed hard to beat benchmarks like the MSCI EAFE index. To what do you attribute IDOG's success, and why should investors who might be suffering from home country bias consider adding some international spice to their portfolios?
Well, if you think about IDOG's methodology, akin to what SDOG, the domestic version of IDOG, does, it gives you really balanced sector exposure. So you're picking the 5 highest yielding stocks in 10 of the 11 GIC sectors, you're equally weighting them. And so your sector composition looks much different than something like the EFA index. And as a result, you might have less exposure to European financials. You might have more exposure to some of the defensive sectors in the market. And so that provides, from a risk reward perspective, certainly a different exposure. But when you're thinking about the US versus ex-US, a lot of people have sort of thrown their hands up on ex-US because it hasn't worked for so long. We're on year 16 or so of the US performing developed ex-US markets. But as a result of the dominance that now US market cap represents in global equity markets, as a result of that sort of ongoing cycle of US outperformance of developed ex-US markets, the valuation gap between US and ex-US markets has widened. The yield spread, so the yield you're able to get in developed ex-US markets versus the dividend yield you're able to get here in the United States, has also widened. And so you've got a valuation opportunity on a relative basis. You've got a yield opportunity on a relative basis. And historically, these cycles don't tend to go on forever. There is a mean reverting nature to that US developed ex-US relationship. And so when it turns, and we expect it to turn at some point in time, it is important to not only have developed ex-US exposure and international exposure in an equity portfolio that's well diversified, but at the same time, you've got a dollar that is very strong. And to the extent that the dollar starts to weaken at some point in the future, that could be another tailwind for developed ex-US investors. So the value proposition for IDOG is balanced sector exposure, relatively high yield, and an ability to diversify away from US markets, which have dominated the equity lexicon in recent years.
All right, let's shift gears, talking about commodities. Commodity ETFs, they've been lifted by higher inflation, and yet the typical investment portfolio has little or no exposure to commodities. The USCF SummerHaven Dynamic Commodity Strategy No K1 ETF, and that ticker is SDCI. This is one potential solution for investors and advisors. In fact, SDCI has outperformed many of its indexing peers. It's actually gained a 4-star rating from Morningstar. Plus, it had simplified tax reporting with the No K1. Tell us a little bit more about that.
Yeah, so commodities, we feel strongly, are an important portfolio diversifier, somewhat akin to what we just talked about with developed ex-US markets. And the reality is that commodities can and historically have provided some insulation from the impact of inflation on an investment portfolio. So an environment where inflation has been running hotter over the course of the past few years than it has over the previous 10 years, that can be an important reason to be diversified into commodities. Also, more recently, the data is at the very least showing signs that maybe some components of inflation are stickier than anticipated, and maybe the deceleration in inflation isn't going to be as swift as the market was anticipating. And we're seeing that being priced in different ways. And so commodities as a diversifier, we feel, is a really powerful portfolio tool. But like we talked about with the ag, like we talked about with IFA, oftentimes benchmarks are inherently flawed. They were typically designed to be measurement tools, not necessarily investable. And so the typical commodities index, the BCOM or otherwise, typically has a lot of exposure at all times to things like Brent crude and WTI and energy markets specifically. What's interesting about SDCI is the index methodology allows it to pick and choose from 27 different commodities on a monthly basis and weight to just the 14, which based on the methodology are expected to be the most attractive based on the shape of the curve, based on other factors related to those individual commodities markets. And so the flexibility, that word once again, of SDCI relative to the benchmark over time should allow investors to get more exposure to some of the commodities that they wouldn't necessarily get in a benchmark-oriented investment. And I think importantly, allow you to maybe take advantage of some of these mismatches between supply and demand that are going to be playing out over the course of the next 10, 15, 20, 25 years as we think about supply disruptions, as we think about increasing demand coming from the electrification of the economy and the energy transition. And SDCI, because of the no K1 format, is a really compelling way for advisors to carve out commodities exposure for their clients.
Paul, one final question before you take off. So although the Russell 2000 small cap index is a popular yardstick for small cap investing, it might not be the best approach for investors with money on the line. In fact, a recent article in Barron's noted that nearly 50% of the companies within the Russell 2000 small cap index are actually unprofitable. So why might a fund like the ALPS OUSM small cap quality dividend ETF, and again, that ticker OUSM, why might it be a better small cap alternative, and how does this fund work?
So you might be sensing a theme here. We're sort of beating up on indexes here, and the Russell 2K is no different. As you mentioned, a preponderance of companies that don't make a lot of money. Companies in that index, a lot of them have floating rate debt, which can be a really problematic feature or bug, if you want to call it that, an environment where rates are likely to be higher than they've averaged over the course of the past 10 years. And so what OUSM does is just try and take that universe and cull it down to a smaller list of securities that are defined by high profitability, so ROA, less leverage, so lower net debt to EBITDA, companies that not only pay a dividend, but have well-covered dividends and dividends that are growing. And so the idea is it's a problematic universe full of warts. And if you can simply take that universe and try and chop it down into a more manageable list of securities whose characteristics are quality, dividends, and importantly, lower leverage over time, that can and historically has led to really strong relative performance, not just in absolute terms, but importantly, in risk-adjusted terms. And so OUSM, we feel, is a great opportunity for advisors who want to have an allocation to small and mid-cap stocks, but don't necessarily want to bear the full risk of investing in the benchmark, whether that be the Russell 2000 or the S&P 600. And we also think that the setup kind of like what we talked about in Developed ex-US on a valuation basis for small and mid-cap stocks, is potentially attractive, but with a number of qualifiers, a number of warnings and disclaimers.
A universe full of warts. I'm going to write that one down, Paul. Paul Baiocchi, thank you so much for joining us. It is great to have you with us.
Always great to be here. Thank you.
Be sure to visit alpsfunds.com to learn more about the ETF lineup at SS&C ALPS Advisors. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you soon.